Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
As of this morning, Jerome Powell of the Federal Reserve issued their official FOMC statement, sharing with us that they unanimously chose to raise interest rates another 25 basis points. So this is where we stand. The committee decided to raise the target range for the federal funds rate to 4.5% to 4.75%, and the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy. And they triple down on their statement that the committee is still strongly committed to returning inflation to its 2% objective by the end of the year. So looking at the United States federal funds rate, we can see with this latest 0.25% increase, we've seen 8 consecutive increases in a row, taking us to levels almost not seen since right before the '08 housing market crash. Taking a look at the United States inflation rate over the last 25 years, and understanding that, yes, inflation has started to creep back down, yet looking actually at max, we're still at levels not seen since the 1980s. Let's talk about what else Jerome Powell said, the Q&A that followed his public statements, and what this ultimately means to you and me as crypto investors. In this first clip out of 3, listen to Jerome highlight that yes, it's clear the economy is slowing. These rate increases don't come without a price. Yet he finishes by highlighting some data, like unemployment, why the economy can afford to take some more.
The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%.
So the rhetoric from Jerome Powell is clearly still hawkish, and he's doubling, tripling down that inflation, while above 6%, needs to finish the year around here. Bitcoin, after that Fed meeting, popped up. The stock market, after that Fed meeting, popped up. The reason the market reacted like this is because the Fed did what they hinted they were going to do. They've been hinting at an increase of 25 basis points, and they did what they said they were going to do. That's what the market likes. And although we're still waiting to see if Bitcoin can cross back above that 200 weekly moving average, this would signify a huge trend change. Looking back again at the federal funds rate and understanding this will be the ultimate trend change if the Fed either pauses or eventually pivots. Jerome Powell did make clear that they would never want to end too early. They'd rather go a little more in the aggressive direction rather than risk being too easy on inflation.
It's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done.
So judging from Jerome Powell's words, as well as their official FOMC statement this morning, expect at least another 0.25% increase next meeting, and then potentially more to follow. Maybe not as aggressive as 50 or 75 basis points like we saw all of 2022, but they're not ready to stop. They're not ready to pivot based on the inflation numbers. But why not just pause a little bit? Can we halt for maybe a month and then reevaluate and then choose to keep going if we need to later?
Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
Well, you'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Now, ultimately, we're going to have a much clearer picture every month that we get new inflation data. In a few weeks, when this data comes out, let's look at it, let's review it together. Now, I want to finish with this bonus clip of Jerome Powell asked specifically about the debt ceiling. But if you'll be in the Los Angeles area March 20th through 23rd, come out and see us. We'll be moderating a panel and hanging out at an awesome conference called Outer Edge LA, formerly NFTLA. Grab your tickets, use code Altcoin Daily VIP for 10% off. And then, of course, if you'll be in Miami later this year in May, join us at Bitcoin 2023, literally the largest Bitcoin conference in existence. Use code Altcoin Daily for 10% off. Both links down below. Check it out. Now, is the Fed worried about this looming debt ceiling?
I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions. So